Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar has risen from the ashes, stock indices are retreating after record highs, gold is looking to the future with optimism, and Bitcoin has failed to break out of consolidation. The US dollar has been rising for 7 of the last 9 trading sessions, with markets kicking expectations for Fed rate cuts further down the road. After a series of strong US economic data, the chances of a federal funds rate cut in January fell to 13% and to 44% in March. However, disappointing statistics for the Eurozone may bring back the idea of a cut in the ECB's deposit rate. The ISM Non-Manufacturing Purchasing Managers Index jumped to a 14-month high. Given the significantly larger share of the service sector in the economy, investors can expect positive dynamics in US GDP. This is especially true as the labor market begins to gradually recover. ADP reported a 41,000 increase in private sector employment in December. In contrast, clouds are gathering over the European economy. A decline in retail sales in Germany and a slowdown in inflation to 2% in the Eurozone led to a fall in the Economic Surprises Index to a monthly low and an increased likelihood of the ECB resuming its monetary expansion cycle in the second half of the year. At the end of 2025, there were many bets on divergence in monetary policy and a narrowing of the economic growth differential between the US and the Eurozone. So far, these ideas have not worked out. The Fed intends to keep rates unchanged, while the ECB may lower them. The result is a fall in Euro-USD. The S&P 500 managed to set new records at the start of the year, but retreated amid strong statistics on business activity in the non-manufacturing sector and private sector employment from ADP. The chances of a continued pause in the Fed's monetary policy easing cycle have increased. Factors such as the reduction in the federal funds rate, the strength of the economy, and corporate reporting form the basis for bullish forecasts for the broad stock index. Wall Street experts expect it to rally by 9% this year. None of the major banks are bearish. Rotation could be the hallmark of 2026. Interest in technology companies is waning amid their inability to generate adequate returns on colossal investments. Securities sensitive to the state of the US economy are popular. At the same time, American stocks are more expensive than European ones. The price-to-forward earnings ratio for the S&P 500 is 22, while for the Euro Stoxx 600 it is 15. The outflow of capital from the US to Europe could ruin the broad stock index. However, the chances of it falling by 30% or more within 12 months are estimated by the futures market at a modest 8%. Such crashes occur once a decade. The strengthening of the US dollar is causing gold to retreat. Nevertheless, Financial Times experts remain optimistic. According to their consensus estimate, by the end of 2026, the precious metal will be trading at $4,610 per ounce, which is just 4% higher than current levels. Central banks will continue to support gold. For example, the People's Bank of China has been increasing its gold reserves for 14 months in a row, adding 1.35 million ounces to its stockpile. According to JP Morgan estimates, central banks will buy 755 tons of bullion in the new year. Their activity, along with the easing of the Fed's monetary policy and the fall in the dollar, is the basis for bullish forecasts for gold. The most aggressive of these, at $5,400 per ounce, is from MKS PAMP. According to the company, the process of debasement trading, or investors dumping bonds and currencies in favor of gold, is only just beginning. In contrast, StoneX sees gold falling to $3,500 amid Donald Trump's defeat in the lawsuit over the dismissal of Lisa Cook. This will convince the markets that the Fed will remain independent and lead to a strengthening of the US dollar. Rumors that Venezuela was creating a shadow reserve of cryptocurrencies after the Americans kidnapped its president allowed Bitcoin to rise at the beginning of the year. However, the Bitcoin rally looked more like a respite than a revival. Despite the best daily inflow into ETFs since early October, investor interest was concentrated in short-term futures. Long-term futures were not popular. Bitcoin was supported by new records for the Dow Jones and S&P 500 indices. However, as soon as the stock market took a step back, the Bitcoin bulls fled. Most outstanding Bitcoin options expiring at the end of the month are clustered at the $100,000 strike. With notional exposure more than double that of $80,000 put options. However, disappointment at the unsuccessful attempt by buyers to break out of the 84,000 to 94,000 consolidation range could result in a sell-off. Market discussion of the Supreme Court's verdict on Donald Trump's universal tariffs, as well as statistics on U.S. inflation and retail sales, will be the key events of the week leading up to the 16th of January. The judges may issue their decision on tariffs as early as the 9th of January, but investors will need time to assess it. Recognizing import duties as legal could have a positive effect on the dollar, as the U.S. would not have to return anything. On the other hand, a ruling that the White House's tariffs are illegal could sow chaos in the financial markets. No one knows what Plan B the U.S. administration has. In such conditions, safe haven assets thrive. The U.S. dollar is one of them. According to research by the Federal Reserve Bank of San Francisco from 1886 to 2017, a 1 percentage point increase in U.S. tariffs slowed inflation by 0.6 percentage points rather than accelerating it. This was due to the cooling of the economy and the labor market. Unsurprisingly, the Fed favors unemployment over inflation in its dual mandate. This reduces investor interest in consumer and producer price reports. Nevertheless, inflation and retail sales data are still capable of moving markets. Stay up to date with global markets in Pro News Weekly. Like, share, and subscribe.